My name is Andrew Betwain, and I am the managing editor of insuranceinvestor.com. Today, I am joined by Stephanie Thomas, senior investment consultant for the insurance practice at Mercer. Hello, Stephanie. How are you?
Hi, Andrew. Thanks for having me today.
Brilliant. Stephanie will be speaking at our Insurance Investor Live Midwest event in Chicago on the 28th of June. She'll be moderating the opening panel discussion on how chief investment officers are navigating an uncertain market environment and what they expect for the remainder of the year. So that's a nice, big, juicy, broad topic for us to get into, Stephanie. So I want to ask you, as my first question is, what are your thoughts on the economic risk cycle and inflation? Do you foresee more changes over the course of 2023?
Well, that's a loaded question, Andrew, but in short, our base case is really that U.S. inflation is going to trend lower. It might settle at a higher level than we've experienced over the last 20 years or so, but those drivers for inflation are really fading. Those COVID supply disruptions have corrected. Consumer spending has somewhat normalized as households really draw down some of that stimulus savings. Wage growth, though, is really feeling those lingering effects, and that has the potential, as you can imagine, to sustain that elevated inflation. So for inflation to really come down and remain contained, economic growth needs to slow in order to reduce that employment demand. So this is unlikely to be a painless exercise, right? As Jay Love, our chief investment strategist here at Mercer, he likes to say, the tools available to slow the economy are blunt and imprecise. So in the near term, our outlook is for slowing inflation, slowing growth, but it has that potential for under or overshooting, and that associated volatility that goes with that. So in the long term, there could still be upside risks to inflation if those governments and corporations rethink globalization and look to increase, their onshoring.
Thank you very much, Stephanie. That was a really interesting answer and obviously a lot to tackle there. Would you be able to give some detail and discuss the effects of inflation on the asset allocation in more depth and what you're seeing in that area?
Yeah, Andrew. So in basic terms, inflation raises that nominal baseline return that you need to maintain your spending power, right? So it's a major consideration, obviously, for investments. A lot of investments, either directly or indirectly, are driven by cash flows, and those are also inflation sensitive, equities, for example. So equity prices are really driven by corporate profits, and those are measured in nominal dollars. So ultimately, your equities shouldn't be negatively affected by inflation, right? Because everything rises together. But corporate profits, as you know, they just don't move perfectly in sync. And they need some time to adjust. And so equities can do poorly in those periods of inflation rising until those adjustments in revenues and costs kind of line up. So other assets have more or sometimes less inflation sensitivity. Real assets are a good example of this, like natural resources, infrastructure in particular. They tend to be more closely aligned with inflation as their value is more directly tied to those nominal cash flows. So they can be attractive in these inflationary environments. Other assets like traditional U.S. fixed income, they do not have that inflation sensitivity built into their cash flows. So particularly on the fixed rate, fixed income. So those are going to suffer more obviously in an inflationary environment. So the asset allocation in your playbook really has to have that exposure to those inflation sensitive assets. Now, ideally, Andrew, you have positioned yourself before the inflationary environment has started, but nonetheless, because we're in this elevated period and the decline is uncertain, I still think that increasing your inflation sensitivity today still makes sense.
There's obviously a lot of factors at play there and a lot of different areas to consider. And you mentioned there about COVID-19 at the beginning of your answer. So my third question relates back to that, and it's where we are currently in this post-pandemic world is, can you give your thoughts on the new normal in insurance asset allocation and where we are with inflation, interest rates, and all the things that you've been mentioning so far?
Yeah, we've been thinking about that a lot, actually. And I would say investment portfolio sophistication and complexity is really that new normal for insurers. that we've had low yields in the past decade, and that's really kind of coerced the industry into getting creative and developing some sophisticated solutions for value creation, both on the asset and on that liability side. But even now, with those increases in yields, the highly uncertain economic, regulatory environments, those are going to continue to make things really complicated. And I would say whether it's in third-party outsourcing, rethinking your core fixed income strategies, the growth of alternatives, that convergence of public and private markets, all of those things are going to continue to influence that asset allocation. And honestly, I do not expect that strategy or this trend really to reverse. And I think it's going to be fascinating really to see what evolves next, because in the meantime, I think investors and CIOs in particular, they need to be flexible. They need to stay creative, keep an open mindset to new solutions, and honestly ask for help. When you need additional resources, some of these situations are complex, and don't be afraid to reach out and get some resources and get some help when you think you need assistance.
That's a really interesting point there, and one that comes up a lot in these conversations. So I wanted to sort of take what you were saying a bit earlier about regulation and the ongoing, the wider picture that we're seeing, and how that relates to my final question for you, Stephanie, which is, what trends are you seeing in this wider economic picture that we have? And how are these interacting with the investment and asset allocation world? So obviously regulatory challenges and all the other areas of the macroeconomic conditions. What are you seeing, and what do you foresee for 2024?
I think the broad view is that we definitely land on inflation being a little higher than where it's been in the past. And that's good news for bond yields and returns, because they're going to be a little higher as well. But really, those real returns might be lower because of higher inflation. And so that's going to affect your equity valuation. That's all in the benign base case. So the more significant areas where you really need to think about and focus on is those tail scenarios. And what do those look like as we now navigate kind of higher rates and that need to slow the economy, slowing inflation. And then on top of it, you've got geopolitical tensions, you've got banking stress, the debt ceiling. I mean, you name it, Andrew. There's a host of issues kind of coming down the pipeline that we'll have to work through. And any of those can cause significant volatility in your capital markets. And I would say, because none of us can really be confident in where they're going to land, where that's going to be for the markets, we really strongly recommend that you have a differentiated set of return drivers, that you continue to have an exposure to a range of asset classes, and that really you have to diversify this portfolio. That's really the critical message right now. And really, in order to have that resiliency and to work on those economic scenarios, I would also suggest institutions maintain a good liquidity position to maintain kind of that cushion in your downside scenario and take advantage of opportunities.
Well, thank you very much for your time, Stephanie. As I mentioned earlier, Stephanie will be moderating the opening panel discussion at our event in Chicago on the 28th of June, which is the Insurance Investor Live Midwest event. And as you can tell, she knows her stuff. So she's going to ask some really interesting, in-depth questions to the panelists. So if you want to see it, you can go to ClearPath Analysis website and register for free and join them on the day and hear Stephanie's excellent analysis of the US insurance market and the trends that it is seeing for chief investment officers. And thank you very much for your time today, Stephanie, and I will see you again soon.
Thanks, Andrew.